This particular chart here shows some of the figures. This is from Statista in terms of the impact of disruption on certain key areas of the market, which are a focus for DRUP, the ETF, and that is here network infrastructure, showing that there's a market size of $239 roughly billion today, increasing to over $300 billion in the next few years. Social networking, obviously, and then to the right, definitely one of the hottest themes, if not the hottest theme of this year, AI. And we can see a significant uplift here in terms of the growth in the AI business from a market size around 184 billion today to a market size of well over 800 billion in just a few years' time.
This is going to be a great educational seminar, let's call it, online as far as how to think about disruptive tech, how to think about accessing disruptive tech through DRUP. And then we're going to have Dan Ives join us in the final 20 minutes to do a live podcast where we're going to ask him all kinds of interesting questions. And for the audience members, you will also be able to ask questions. All right, let's get started. Hopefully we'll get some good back and forth here with all of you who are watching this live as part of this webinar. My name is Michael Gayed. This webinar is hosted by Lead Lag Media, my entity, on behalf of GraniteShares. We're going to be talking about DRUP, the Disruptive Tech ETF. And joining for the beginning part of the webinar are, of course, the founder of GraniteShares, Will Rhind. Will, I don't know if you want to share your screen to kind of get us started here.
Yes, sir. All right. Most importantly, can everybody see that? Good.
Yep. All good on that end. So we can go right to the second slide. So quick intros again. Will Rhind, the founder of GraniteShares. He's going to talk about his background here. If any of you want to ask questions during this webinar, put it in the chat. We want to make this as interactive as possible. We're going to do a Q&A at the end as well. But Will, I'll leave it right to you to talk about how wonderful you are.
Well, thank you very much, Michael. And thank you, everybody, for listening to today's webinar here on disruptive technology. My name is Will Rhind, founder and CEO of GraniteShares. We're an ETF company headquartered here in New York City, as you can see probably out of my back window. We're a leading global ETF issuer, so managing over 10 billion in a number of different strategies, but businesses here, predominantly the US, Europe, and in Asia. Specifically, we manage a number of different ETFs covering a number of different themes or sectors of the market. So from real assets on the commodity side to concentrated equity exposure, which we'll talk about today, obviously, short leverage single stock ETFs, and also alternative income, but wrapped together in our sort of investment philosophy of high conviction investing. And again, this is very relevant for today's topic where we'll be discussing disruptive technology. A couple of slides quickly about our offering. Most relevant here is our DRUP ETF, which will be the subject of the first part of this conversation, which, as you can see, just second from the bottom there, the GraniteShares NASDAQ Select Disruptors ETF, ticker code DRUP or DRUP. And then our platform of leveraged single stock ETFs. Again, a lot of disruptive companies in the mix here, but most of these ETFs provide either 2 times long or 2 times short exposure to some of the most popular tech companies out there. All right, so let's get into the subject of today's presentation and talk about disruptive ETF. So what we're trying to do here is try and reduce the forward-facing risks that are disruption in the market, and think about, how we can sort of inoculate portfolios from these risks. So this ETF is designed to offer investors exposure to companies driving change and at the forefront of growth through disruptive innovation. And we can think about disruptive technology being a synonym for innovation, investing, for a different type of growth investing more broadly, but we are speaking specifically about disruption today. So what obviously is disruption? And this is just taken from the Oxford English Dictionary. The definition states that disruption is radical change to an existing industry or market due to technological innovation. And disruption matters because it's happening all around us and it is fundamentally changing not just the financial markets, but the way we invest more broadly. So technological change, if you look at the second part to this particular chart where it says shortening lifespan of companies, the average lifespan here of a company in the S&P 500 has dropped from around 60 years back in the 1950s to less than 20 years today. So the average lifespan of companies in the large cap indexes is getting shorter and shorter. And the reason for that is technological change. So with technological change comes risk, and that is risk to incumbent business models, to incumbent businesses. And of course, lastly, the investment opportunities that are created with that if you're able to capture the most disruptive companies or most innovative companies in the market. This particular chart here shows some of the figures. This is from Statista in terms of the impact of disruption on certain key areas of the market, which are a focus for DRUP, the ETF, and that is network infrastructure, showing that there's a market size of $239 roughly billion today, increasing to over $300 billion in the next few years. Social networking, obviously, and then to the right, definitely one of the hottest themes, if not the hottest theme of this year, AI. And we can see a significant uplift here in terms of the growth in the AI business from a market size around 184 billion today to a market size of well over 800 billion in just a few years' time. So the compound annual growth rate for AI eclipsing that of social networking and of network infrastructure. But again, three key themes that we'll be discussing a lot as we go through this. And this particular chart as well, again, looking at the impact, the economic impact of disruptive technologies in 2025 by technology type. And again, similar to what we were discussing on the last page, if you look at the bottom of this particular chart, you'll see, broadly speaking, although they're defined in slightly different ways, that these sectors or these themes represented here in terms of the highest impact. You see AI, mobile, internet, cloud, all represented kind of at the bottom of this chart, which again, no surprise, are themes that we are representing within the portfolio. So what makes a company disruptive? Now, this is important because disruption means different things to different people. And as we'll be discussing in this particular presentation and in this conversation today, the important takeaway is that we have a framework for analyzing this. And while we can all think of disruptive companies, whether it's a Tesla or whether it's a Netflix or whether it's an Airbnb, etc., the important thing is how we are doing disruption. And in the context of today's presentation, this is not just this sort of blue sky approach of buying companies, investing in companies that are exhibiting characteristics like growth at all costs, but there's a framework to think about how disruption can be measured. And when we think about that framework, some of the important components of that are the key traits that are important when we look at what makes a company disruptive. And that's going to be things like the spending on R&D. In other words, disruptive companies typically are spending money on research and development. This is something that drives a lot of economic value through patents, both exploring and then registering and enforcing patents. So large patent portfolios are typically another characteristic of this. growing revenues, of course, is really important to grow revenues, but at the same time, that focus on quality to make sure that it's not just about companies that are able to grow at a really rapid pace, but companies that also are able to exhibit profitability and have that quality tilt. This slide here, I think, is kind of one of the key things, again, when we think about what is disruption and how do we actually visualize that in the marketplace. And what you're looking at here is what we call the power of intellectual capital. And this is just how the market has shifted, the value has shifted within the market from tangible assets to intangible assets. And if you look on the left-hand scale, the sort of the light green color, if you will, this is represented in the context of tangible assets. So, back in the 70s, back in the 80s, the vast majority of how we valued companies in the market, how we ascribed value to companies was around their tangible assets. And you can see that back in the 70s, this was over 80% of the market for large cap companies was in tangible assets. And look how much that shifted to this sort of the light blue color over time, which is on the right scale. That's intangible assets. And intangible assets, of course, are things like patents that we were discussing, brand value, customer data, software, etc. Now, these things, as at least of 2020, and even this is a little bit out of date, but now represent the vast majority of value in the market. And of course, we know that from the dominance of some of the largest tech companies in the market. And this particular chart, again, looks at the contribution to earnings growth in the S&P 500. And again, in the sort of the lighter blue, if you will, that's the Magnificent Seven companies. And then the lighter green is the rest of the market. In other words, the other 493 companies. And, as you can see, so leading the pack in terms of earnings growth in the S&P 500 has been the Magnificent Seven now for a long period of time. And, this is a sort of something that is not just, an omnipresent, factor in the market that I think most people, if not all people, will be aware of, but is something that we expect to continue. So
I will say real quick, I think this is like one of the most remarkable slides in the deck, just because it shows you that it's not just hype. I mean, the earnings story is very real.
Yeah, absolutely. And I think, again, we sometimes have to remind ourselves when we talk about, maybe we can talk about this when Dan jumps on, but in a market where markets are at all-time highs and where we are breaking new highs almost on a daily, if not weekly basis, we have to remind ourselves that, one of the most important factors driving this particular market has been earnings. And we can all talk about, some of the other macro factors, and they are important. I'm not suggesting or trying to downplay them, but earnings have been very strong. And that is, in my mind, the primary reason why we've seen such strength in the market. So let's look at disruption in a little bit more detail and specifically sort of how it applies to the DRUP ETF. Because again, disruption is not created, all companies are not created equally. That this is about trying to isolate companies that exhibit particular qualities that make them eligible for an investment strategy. And again, not every disruptive company, there are plenty of examples of disruptive companies. Not every company will succeed. And what we're trying to do is identify companies with the highest potential for long-term success. So in this particular chart, as we said, not all disruptors are created equal. The companies most likely to achieve long-term success typically have two major traits. One is the monetizable innovation. So whatever the disruptive technology is will translate directly into revenue growth and market demand and leads to a defensible position or a moat. In other words, that the innovations that they have produced through the technology is giving them a competitive edge that's enduring, something that is able to produce typically large amounts of profits from a position in a given market or sector that has dominance. And you can see some of those companies at the bottom here, and this is the holding in percentage terms in the DRUP portfolio as of the end of September, the last quarter. And you have companies like Meta, Microsoft, ServiceNow, Salesforce, and Adobe. So this particular chart here, this is the S curve of growth that any successful company goes through, and this is going from the startup phase into growth scale or growth stage through to the scale stage and then maturity. And what's important to say about this particular chart is that a lot of either high growth ETFs or a lot of technology or disruptive innovation based ETFs focus on this early part of the S curve, and that is the phase from sort of startup through to scale. And one of the lessons learned over the last few years was that that's fine in particular market environments, particularly where you have zero interest rates and the markets are awash for capital. But when we start to have money being factored in or a real value of money, interest rates moving up, inflation moving up, that seriously affects this. And again, the DRUP strategy focuses on all parts of the S curve, not just these early phases, but also the maturity or the monetization phase of these companies. And there are a number of examples, again, about disruptive companies that have not made it. And again, this point that disruption is not created equally, that not every company that we can look at and say, oh, that's a disruptive company is going to succeed. And so some examples here, but clearly if you look back of the experience just of the last few years, from the pandemic, companies such as your Zooms, your Pelotons, even Nikes that were massive success stories in a particular environment. When market conditions changed, that story or those stories changed as well. Disruptive companies doing disruptive things, but wasn't enduring, couldn't last or couldn't change as the market environment changed.
I want to add something real quick to this because I think this is, I know we're going to touch on this a little bit later, but for those that are listening to this, you may have noticed that NVIDIA was not mentioned on the holdings. And it's not mentioned on this, but NVIDIA is not a part of the portfolio. And I'm looking right now at DRUP year to date versus the NASDAQ 100. DRUP's up around 30%. NASDAQ 100 is up around 27.9. So to do that without NVIDIA, which I know Merrick is going to hit on the index, is pretty remarkable.
Thank you. And that is, again, a great point, which we'll discuss further. But it's not only that, Michael. As you know, that NVIDIA clearly is a massive success story that will get all the headlines. But it's actually 4 companies in the Magnificent Seven. So, another critique of some of the growth ETFs, of the innovation ETFs, is that they're all really Magnificent Seven ETFs in disguise. And again, what's so unique about something like DRUP is that that's absolutely not the case. And you only have 3 of the Magnificent Seven in there. And there's a very, again, disciplined and well thought out process in terms of how to select companies. This is an example that everyone's familiar with, but again, we could have hundreds of these examples, even just from the last few years, in terms of companies that were eclipsed by the new technology in that particular space. Everyone knows, of course, the story of Blockbuster and Netflix going on to obviously capture the market for streaming and be the dominant player in streaming as everybody moved away from previous technology. But as we've said with the pandemic darlings, that there are so many examples of this, and it's happening all the time. So identifying disruptive innovation in markets. Again, this is more the risk factor around disruption, in that disruption is more than a trend. It's transformational force and is a forward-facing risk. And when you look at the speed that some of this transformation is taking place, whether it's AI, whether it's other parts of the technological sort of sphere, it's really about how to protect portfolios from this risk, from this change, and make sure that you're exposed to the right sort of opportunities. So as we talked about like a couple of times already, that we have the luxury of when we brought DRUP to market, we had learned the lessons, or we had observed the lessons learned by others in terms of high growth innovation, high growth disruptive strategies that were in the market, before the pandemic, during the pandemic, and then after the pandemic. And there's a few clear takeaways here that we tried to bring to bear when constructing DRUP. And one of them is the lack of disruption metrics. In other words, lack of a framework or discipline around what the disruptive company is and how to capture that. Another one is over diversification. So companies that, or strategies that include a lot of different companies with no particular purpose other than, perhaps a focus on just size or a particular style. And again, including all companies as opposed to being selective. And then lastly, the exposure without that insight. So unintentionally impacted by disruptive shifts without targeted risk management, or in other words, exposure to sort of style factors, et cetera, sometimes unintended within a portfolio of companies. And the key thing is that the DRUP ETF, we aim to do this differently by offering a high concentrated exposure to the most disruptive names in the market, but doing this in a very disciplined way. So in terms of the highlights here, which Mark will talk about more broadly, but the ETF is benchmarked to the NASDAQ index, which Mark will talk about. The key benefits to the investor are that it has concentrated exposure to a select group of companies. It has selective and stable methodology. So passively managed, New York Stock Exchange listed, the ticker is DRUP, and it's a pure play on disruptive innovation, disruptive technology. And I think, like any ETF, it's always important to talk about liquidity. These are large cap companies, and with large cap companies that are US based, so not international, it makes for a liquid investment strategy. So being exchange traded, investors can buy and sell, of course, during the market hours. And given the fact that the underlying are US large cap stocks, there's ample liquidity in the strategy. So in terms of DRUP itself, why choose DRUP for investment? As Michael set out, the performance has been really, really strong, and really strong doing it in a different way to what you might expect with just a typical growth ETF or innovation ETF. That is to say, doing it without some of the superstars of the last couple of years. So setting the benchmark for disruption or disruptive investing, capturing the disruptive technologies at the right moment. We talked about the S-curve and the different stages, but capturing it at the right moment, maximizing the growth potential, focused and impactful exposure. So with a concentrated approach, you have high potential disruptors without unnecessarily dilution or over diversification, and addressing the passive investing gaps. So filling the gaps or the weaknesses with generic passive investing that just buys any company in a given index indiscriminately or in any market indiscriminately, and not focus on sorting the good companies from the bad companies. And then, of course, lastly, probably most importantly, backed by a rigorous methodology. In other words, there is a methodology to how we select disruptive companies and what that means in the context of the index and the strategy. So in terms of how to use it in a portfolio, it can be positioned in a number of different ways, but clearly as a single sleeve for disruption. So to replace, traditional growth exposure or even large cap exposure in some cases, but it is there as a potential sleeve for disruption. The satellite to a core allocation, so where people might have a core allocation of a more broad market exposure or even global exposure, looking to, again, address the risk of disruption through a single sleeve allocation as a satellite allocation to something like DRUP. Thematic equity replacement, so where you have sometimes different themes from a marketing perspective that underneath the hood contain stocks that are either very similar or highly correlated, a chance to replace some of these overlapping themes with one particular ticker solution, and the enhanced client narrative. In other words, most importantly, telling a story to clients or investors about the risks of disruption and how to try and insulate yourselves from these forward-facing risks within the portfolio.
Can I ask Will real quick on this? Is it fair to think about this situation, the core satellite idea, that if you're going to take away from something in a portfolio to go into DRUP, that the closest thing that makes the most sense would be to take away from the NASDAQ itself rather than anything else, because it's basically much more diversified, it's performed better, and it doesn't have that NVIDIA risk.
Yeah, I think it's really what core means. So core means different things to different people. I mean, some people will have a more conservative, core. Some people will have, more exposure to technology, et cetera, in there. But I think the idea with any core satellite strategy is to kind of, double down on the risk or the opportunity that you think is not covered adequately in whatever core allocation you have. And this is really trying to address that in a very sort of targeted way.
That was very well timed. I was actually sending a message to Dan saying 4:45 is what we're aiming for, right on time. What's up, Dan? How are you?
Hey, great to be here.
Yeah, man. You're always, I love what you're rocking clothing wise. I'm always jealous of the local aspect of it. I mean, you got to stand out somehow, right? I got this little Phoenix thing. You got the full outfit. So from that standpoint,
I like that Phoenix, and that's cool.
It's part of my gimmick, right? From that standpoint. So look, I want to start off the conversation here around the idea that we could be entering an age where we will see more disruption across more companies. I think everybody now obviously has accepted that the most disruptive entity out there is NVIDIA, but NVIDIA should be enabling other companies to be disruptive because of generative AI and chips and GPUs. I want to get your thoughts on the idea that we will see more and more disruption and more equality, let's call it, in terms of the companies that are being disrupted, more companies that are coming out there and trying to do things that are different.
Yeah, I mean, look, I just say the multiplier effect. For every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier for spending across the rest of the tech. And that, look, I mean, you've talked about this over the years, right? I mean, the bears, they don't see AI in their spreadsheets, when they're in their caves. But the reality is that this is a once in a 40, 50-year revolution. And it starts with NVIDIA. Look at Salesforce. Look at the Messi of AI, Palantir. Look what's happening at ServiceNow, Oracle. Look, this is just, we talk about it's 10 p.m. in the AI party that goes to 4 a.m. And now software, last night, they got let in on the velvet ropes. They're in the dance floor. And that's sort of might be broader, right? Like this is just going to go to the second, third, fourth derivative as the use cases build out and everything we see playing out across tech.
I know Will and Mark have some burning questions.
Yeah. Set it up nicely.
Hey, Will. Hey.
Good to see you. I think one thing that perhaps we get a lot of questions about that'd be good to get your view on, I know you've written about it a lot, is with the president-elect obviously coming in, with Elon Musk sort of riding shotgun, we're expecting to see quite a lot of change, positive change, in the market. I know you've talked a lot about, what some of those changes might be, particularly with the FTC and the tailwind for tech, but perhaps just give your view, 30,000 foot on what you're thinking in terms of coming into year end and what we look like for next year.
Yeah, great questions. I mean, one, obviously the thorn side for tech, it's been a twilight zone situations, con at the FTC. Those days are ending, right? It's just a matter until that press release comes out that she's done at the FTC. That's hugely bullish for more deal making. I think you'll see a lot of M&A in tech get stronger, specifically big tech. I think you'll see a lot more M&A, specifically on the software side, cybersecurity, infrastructure, potential on grid, and even on the energy side. And then overall, especially on the bromance between Musk and Trump, this really just means things like autonomous technology are going to get fast tracked. A lot of the deregulation that we've been hoping for, we're now going to see in the Beltway. The only thing that was really going to get in the way of this AI revolution, it was the grandstanding red tape 202 area code. Trump coming in, Goldilocks scenario for big tech. I kind of view it as this is now going to accelerate our view of the AI revolution by potentially 2 to 3 years as it all plays out, specifically autonomous and some of these other areas.
Can I ask you, do you think that, assuming that that's the case, I think it's logical. Has the market started to even price that in terms of the other companies outside?
No. Look, and I think, and I've been listening to what you guys are talking about. It's the New York City cab driver is bullish on Mag 7 or NVIDIA, right? So, and I think those are continuing ones, NVIDIA for potentially $5 trillion market cap next 2 or 3 years. But I think the biggest area, it's trying to find second, third, fourth derivatives of AI. That's where we are. It goes back to, if someone said a year ago, Oracle is an AI derivative, you're like, you must have had a great night last night. Now look what's stock. Palantir, they hate it as a teenager, despise it as a senior citizen, right? Theirs can't find AI in the spreadsheets. So the point is that now we're starting to look at Salesforce, ServiceNow, the second, third, fourth derivative. It's all about the multiplier. 2 to 3 trillion of AI CapEx coming to tech. Get out the popcorn. It's our view why tech stocks are up another 25% next year. One event.
I know there's so many companies that we could talk about, but maybe Dan, do you want to just talk about a few companies that sort of are on the top of your thinking? I know you've mentioned a few of them already, but in terms of who are the big winners here in your mind, especially when we think about next year?
Yeah, and look, and obviously the biggest winner this year, in the Messi of AI, Palantir, I think many on the street. Many on the street. Remember, it's again, it is a teenager, despises a senior citizen, not really understanding what they're doing from an AIP perspective. They have an algorithm, they have a model that I really view as not replicable. I view Palantir as who's the next Oracle, the next Microsoft, next 8-10 years. I believe, in my view, it's Palantir. When you look at other winners, of course, on the chip plays, those have been the winners, NVIDIA obviously being one of our favorites. But I actually think when we go into next year, software is going to be front and center. Salesforce, that's the inflection point where we're seeing from bending off. But it's just starting. ServiceNow, Salesforce, Oracle. What I ultimately believe is going to now the consumption names, MongoDB, Elastic, Snowflake, M&A with Con out at the FTC, just a matter of time until the press release hits. That's going to spur more and more deal making. It's golden. Look, if you're a bull, I kind of view it as sort of a champagne moment, especially with Trump administration, Musk, right next to him in the, sort of White House, as this all plays out over the next year.
Sometimes we get questions on, this is obviously 50,000 foot view of the world, but with, Trump and with Elon, you have to believe that, and I know there was a very interesting podcast that Joe Rogan just did with Mark Andreessen. And they talked a bit about the Biden administration strategy around AI, which clearly you got to believe is going to be very different under Trump and with Musk. But sometimes we get asked, what does tech look like around the world? And are there any stories that are investable, in Asia or China specifically,
sure,
Europe, and why is the US so far out in front?
So I'd say, look, as someone like myself spends so much time Middle East, Asia, around the world. I think for the first time in 30 years, the U.S. is ahead of China. when it comes to AI. I mean, who are the biggest AI players are basically all US, right? So I think around the world, especially as so many around Asia in the middle can't invest in China, can't invest in Chinese tech. I'm not saying Chinese tech is maybe oversold, but you're just seeing more and more. Maybe they had 10% US tech. Now it's 30%. You go to some of these areas, you talk just Microsoft, Apple. Now they want to understand what's going on with Palantir. So I think where I see everything going is you're going to see more and more getting stronger in the US. Second, third derivatives playing out. AI innovation labs. I think in terms of Inflation Reduction Act, a lot more is going to be focused on AI and innovation instead of just Intel. I mean, that's a poster child, right? I mean, I'll give them $2, they'll spend $3, and I'll never see the returns, right? So the point is that you are going to see a much dramatically different spending cycle around AI, innovation, specifically, and also in the Beltway as this all plays out. And I think Musk is going to play a key role understanding AI probably as better as, I'd say as good as anyone in the world.
I think the whole space is becoming more and more fascinating. And I think as it relates to this webinar, DRUP is really an interesting way to play it. One of the things we were talking about is how do you define disruption? Index obviously does that for DRUP. I'm curious for you as somebody who's seeing this stuff. I mean, it's one of those things where it's kind of like the definition of profanity. You know what it is when you hear it. It's like, you know what disruption is when you see it.
I agree. I mean, and that's why going back to 2022, seeing what NVIDIA was doing, right? That to me was like bread, water, and you buy NVIDIA. I mean, that was sort of the call, right? Like, in other words, but I think the disruption now, to your point, there's companies that today, if you don't view them as disruptive, but if you start to go out to like the grid, energy, cooling, I'm just giving examples, like some of the use cases.
Like the value chain sort of.
That's there. But Will, I think like that's the whole point here is that every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier across the rest of the tech. So the point is, somebody like myself that's covered tech for the last 25 years, and like anytime tries to show you, Cisco 99, NVIDIA now, I covered them back then. You can't even compare. You're talking about $2 trillion of AI CapEx that's already out. It's coming from tech companies that have $1.2 trillion on the balance sheet, generate $400 billion a year in free cash flow, and could buy countries if they want every quarter. So versus 99, .com bubble, leverage companies, startups, Ether, everyone else. That's where I view it. I mean, that's why, I think we sit here a year from now, and the question is, how much more could tech go as the bears, again, it's like I said, valuation, $3, get you a cup of coffee, earn $6,000. But then it also goes back to if many bears were NFL scouts, they would have been negative on Brady coming out of the 2000 draft, right? And after one Super Bowl, can't do it again. What about the kid? But that's what I love. I just think the environment set up with all the money on the sideline, still skeptics, to sort of get the popcorn out.
Hopefully, everyone that watched this webinar is no longer a skeptic. Special thanks to
the haters continue to hate.
The haters, exactly right. Well, that's why you have their clothing. When you want to shove it in their face, it's like they can hate on you, but you got style, man.
Haters hate. Haters hate. That's what they do.
I get it. But appreciate those that watch this webinar. We're going to try and make this available for those that maybe came a little bit late with its own video. If you have any feedback, we're going to try and do these webinars fairly regularly. If you have any feedback, shoot me an email, michaelgayed@graniteshares.com. And I'm happy to take any kind of constructive feedback, including from haters that might be here for going forward webinars. Thank you, Will. Thank you, Dan. And thank everybody for joining.
Yeah, thank you, everybody. Great conversation.
Thanks.
Cheers, everybody.